So I think before we get started, I just want to point out this word alternative investments. What is it? And so what I did was I went to the web page of one of the leading investment banks. There are two of them left now, the historic two. And I was not supposed to put in their names, so I've deleted that. But if you go onto their website, they say we have 300 billion managed under alternative investments. So there is no standard definition for it. But I think what I can gather is if it's not public debt or public equity, then it is alternative. That's kind of what I can see over there. So if I look at it, there is private equity, private credit, that's new, and it's growing. Then there's hedge funds. And within this theme, you can see climate. And then we have real estate, infrastructure, and managed futures, which also overlaps with hedge funds. And out of these, I think in terms of private equity, there is considerable amount of research. There are many papers over here. So I thought that these three areas are something that we can probably learn from. It's new work, and we can gain some insights on discussing what are the recent research questions, what are some of the common areas that are helping in the growth of these areas. So quickly, in terms of motivation, I think this is frequent database until 2022. And if we look at the total assets under management, it's nearing 10 trillion. And that's pretty significant. If you look at allocations of endowments, UTIMCO, Close Home, UChicago, and so on, alternative investments is a pretty significant part. And if you just look at the amount as a percentage of the markets, if you look at, and this does not include hedge funds, by the way. So if you look at the size of the debt markets, it's around 50 trillion. Then this 10 trillion is pretty significant, and it is growing. So the motivation was we just understand what is it that's driving growth in these markets. And I know we read about each one of them, but in a systematic way, thinking about what's the reason that product is surviving or is there? Who is the product trying to serve? And that's the idea of putting the session together. So I'm going to invite Young Soo to get us started. And so each one of them will take around 10 minutes to discuss them, give us some background information, and then we will put it together right towards the end.
Great, so I'll get started. So I'll provide some definitions and then talk about some salient features and then talk about the performance. So private debt is also interchangeably referred to as private credit. But if you look them up in Google or Investopedia, the definitions are in flux. I can first tell you it is not traditional bonds and it's not traditional loans, traditional bank loans. And there's also one common misconception, that is the word private refers to the instrument, not the borrower. So technically, public firms can use private debt to raise financing. But it is true that it's mostly private firms that use private debt, and in particular, those backed by private equity. So what does it include? First, obviously, private debt funds. But private debt funds can be divided into different strategies. So most predominantly will be direct lending. You also have mezzanine debt and also distressed debt. Business development companies or BDCs are also play a big role in private credit, although Preqin does not track BDCs. In some places, they also include collateralized loan obligations, but some places they don't. Today, I'm just going to focus on private debt funds, in particular direct lending funds, and BDCs. Collectively, I refer to them as direct lenders because their primary lending strategy is direct lending, meaning that when they make loans to companies, they tend to directly originate the loan without bank syndication. And some of the top private debt fund managers are Antares, Barings, Blackstone, Carlyle, Oaktree, and some of the top BDC managers are Ares, Apollo, Golub, Allrock, Newmount. And you can already see many of them are affiliated with private equity firms. In fact, around a third of direct lenders are affiliated with private equity firms. So let me provide some more detail on direct lenders. So in terms of financing, as I mentioned before, they use private debt funds and BDCs. So private debt funds are essentially closed-end funds structured as limited partnership. So you can just think of them exactly the same as private equity venture capital funds, where the general partners or the GPs who make the investment decisions raise long-term capital commitments from their investors, the LPs or limited partners, which tend to be long-term institutional investors such as endowments, pension funds, and insurance companies. So BDCs are a special type of closed-end fund that are registered under and regulated by the SEC. I would like to point out 4 key distinct features. First of all, BDCs were also created as part of the legislation to spur small firm growth. I believe that was a legislation many years ago. So by legislation, they have to invest more than 70% of their investments or more than 70% of their capital into private firms, mostly in the form of loan investments. Second, they're mandated by the SEC to disclose the fair value of their entire loan portfolio for each individual investment on quarterly basis. And because a lot of these loans are illiquid, they oftentimes use third-party valuation services to arrive at those valuations. Third, there's tax benefit. So as long as BDCs distribute more than 90% of their investment income through dividends, they don't have to pay any corporate taxes. And fourth, some BDCs are private, but many are public. So there's about 40 to 60 splits. So 40% of BDC assets under management are run by private BDCs, where public BDCs, they just list their shares on equity exchanges through an IPO, such as we as retail investors can also invest in them. So these are all kind of equity financing they raise, but both private debt funds and BDCs also use some leverage. They use some leverage at the fund level. Typically, private debt funds will get bank debt, and BDCs, they rely on both bonds and bank debt. So in a recent survey work that I participated in, where we surveyed a meaningful group of private debt funds, both in the US and Europe, we find that private debt funds typically use less than 1-to-1 in debt to equity in terms of leverage. And BDCs, they're required by legislation such that they can only use up to 2-to-1. And my sense is they use 50 to 60% leverage ratio. So 1-to-1 mostly. So into the total assets under management. So in the US, private debt is around $900 billion and BDCs around $270 billion as of 2022. So that's on the financing side. So on the investment side, what they do is direct lending primarily. So they make loans to companies, and then when they make loans to companies, they directly negotiate the loan with the borrower without going through a bank syndication process. They do occasionally syndicate among each other, among other direct lenders, but if they do it, it's oftentimes done among a small group of lenders, like rarely exceeding 5. So not as broadly syndicated as like bank syndicated loans. Also, post-origination, they tend to hold to maturity and rarely engage in secondary market trading. And who are the borrowers? So borrowers tend to be middle market firms. So middle market firms, as the name speaks for itself, sits right in the middle of the firm's size distribution, and typically defined as firms with sales between $10 million and $1 billion. And these firms are primarily used for private equity buyouts. For those of you who are not familiar with the term buyout, it essentially means a private equity investor, they're also called a private equity sponsor, acquires a company using large amounts of debt, and they play an active role in firm operations. And historically, these debt came in the form of bonds and bank loans, but today more and more now provided in loans by direct lenders. So in our survey, when we surveyed these private debt funds in the US and Europe, especially in the US, they say that 78% of their loans they make are used for buyouts. In the case of BDCs, in my job market paper, I find that around 63% of them are used for buyouts. So you can see here there's a trend in the past 20 years. It's gone through exponential growth. So around $1.5 trillion of private credit as of 2022 and around $900 billion in the US. BDC similar patterns on $270 billion as of today. So now I'll talk about some performance. So I'm not an asset pricing person, so I might not have a great insight into explaining all of these, but I just figured I'll provide some interesting statistics that you might find interesting. So Cliffwater has a direct lending index. They have been tracking direct lending for the past 20 years. And they report that in the last 20 years, they have annualized return of 9.37%, unlevered and gross their fees. The Block et al. Is a survey that I mentioned they are participated in. When we asked them, they said that their target unlevered IRR is 8.16% and levered IRR of 11.18%. So you can see these are quite consistent. So Monday et al. Is a paper that uses the Burgess data. So I believe Burgess is one of the most comprehensive data on private capital fund returns that academics have used. And they show that private debt funds, and especially direct lending funds, have outperformed leveraged loans and high yield bonds. Lincoln International also has a private credit index, and they also shown in this figure below. Maybe you can see but the green line is for their private credit index, and the blue line or the black line is the Morningstar leveraged loan index. And they've also shown that private credit has outperformed leveraged loans as well. I think this is one of the most fascinating part, which is they've outperformed leveraged loan high yield bonds, but somehow with lower volatility. So, the first figure on the left is from a white paper from Ares. Ares is one of the biggest BDCs in the U.S., and their white paper was very widely cited among industry practitioners. And they report that the standard deviation or volatility of the U.S. middle market loans, shown in the first bar here, which are mostly provided by direct lenders. Somehow they've had much lower volatility than leveraged loans, high yield bonds, and S&P 500. So Lincoln International also plot the volatility for the Morningstar index as well as private credit index that they publish. They also show that lower volatility. So as we all learn for Finance 101, return comes with risk. So this is a puzzle. Is it really that alpha that they're capturing, or is it some? I think there's a concern in private equity in general that returns may be smooth. So I have no prior on this, so I think this is also quite interesting to know in the future as well. Yeah, that's everything I have for today. So thank you.
Any quick questions for them before we move on to
Right. So, I mean, by construction, of course, because these are liquid loans, you rarely see trades. So, it may not be an apples to apples comparison to look at volatility. So I think, that's a great point. And, one thing I can tell you is that, yeah, the private debt funds and BDCs both often use third-party valuation service to get up those valuations. And so later in the slides, I'll have some questions about that as well. It would be great, to know in the future.
let's get on with an overview of hedge funds.
Thanks, Karan. Yeah, that was a question. I was going to bring it up later on the discussion. So it's good that because you do see that in hedge funds as well. And there's been work on smoothing of returns in hedge funds. And so it's obviously going to be much bigger in the private space. So Karan asked me to kind of do this more like a tutorial, as he said. So this might be very, very basic, but I just wanted to give a very, just start off with what hedge funds are for those people who are not familiar, but I see a lot of experts in this room. So hopefully all of you are very familiar with this. But, when I teach a class on hedge funds, I usually tell people they ask me what's the definition, and there is actually no definition of hedge funds which is commonly accepted. And a lot of people don't even know that hedge funds have been existing for a long time. And so the father of hedge funds is usually a person called Alfred Winslow Jones, who started a first fund in 1949, and he didn't even call it a hedge fund. He basically came up with the idea of going both long and short, and he said, why do all these mutual fund managers just take long positions when there are opportunities to make money on the short side? And so he basically started a fund where he invested substantial amount of his own money into the fund. And that became actually a unique characteristics of hedge funds, where the manager actually co-invests in the fund. So he's put a lot of so he started with $100,000, which was a lot of money in 1949, and $40,000 of that was actually coming from him. Much later in 1966, there was a journalist by the name of Carol Loomis. She actually coined the word hedge fund because there was this element of hedging which was coming from the fact that you're taking long and short positions at the same time. But what has happened ever since then is that the industry has evolved, and now hedge funds basically invest in anything that moves. So basically you can think of, like, in the 80s, we had Julian Robertson and George Soros who were running macro funds, taking huge directional bets. And, and now, as I'll talk a little bit later, now they moved into cryptocurrencies and, all kinds of different asset classes, including private debt as well. And so one way of thinking about hedge funds definition is like, what are the characteristics that define a hedge fund, right? So they are privately organized. This is a very key element. So these cannot be publicly offered, and which means that they can only accept investment from what we call as qualified or accredited investors. And there was a definition of accredited investors that has been around for a long time, which says that you need to have an annual income of $200,000. If you're single, and if you're jointly filing, then it's $300,000 over the last 2 years, or you need to have a net worth of $1 million. So the underlying sort of thought is that if you are rich, you are smart, right? But that's not necessarily true, right? So the SEC said, well, why not we modernize this definition of accredited investors? So this is actually very recent, where they said, okay, we'll have now 2 criteria for defining accredited investor. One is the financial criteria that I just talked about. The other is the professional criteria. So if you are somebody who is having the education in finance, you understand finance, then you are allowed to invest in hedge funds, because the whole idea is that, look, hedge funds is not for everybody because the risks are different, as I will talk about later on. And therefore you need to be fairly sophisticated or rich enough that you can hire advisors who can actually advise you on how to invest in hedge funds. And the last feature is, of course, they are not highly regulated, which actually comes from the fact that they are not really selling to the public. So you can't actually solicit investments. You can't advertise on the TV. You wouldn't have seen an ad of a hedge fund. You can't even enter the website of a hedge fund, because they wouldn't allow you to do that unless you are a accredited investor. So they are not as highly regulated as other investment companies, like, including open-end mutual funds. So what do they get in return? Well, they get in return a lot of flexibility in terms of what they can do. They can use leverage. They can invest in highly illiquid securities. They don't have this cap of 15% that mutual funds have on how much illiquid investments they can make. And the goal of the fund manager is to deliver absolute return. And that's been one of the focus of the academic research, to really understand that are these returns really absolute, or what is really driving the returns? Is it, they are exposed to certain factors? Are they market neutral? Because they're supposed to deliver the return regardless of how the market does. And then, of course, the managers are compensated in a very lucrative way, 20% performance fees, and 20% of the profits are paid to the manager as the performance fees. And then you have 1 to 2%, which is asset-based fees. And then another feature which you see in the hedge funds is that they have restrictions on withdrawal of capital by investors. So typically you will have lockup period. When you enter the fund the first time, your money is locked up for 1 year. And even after that, if you want to withdraw your money, you have to basically give a notice to the manager, which might be a month. And then you will be allowed to only redeem your money usually on some frequency, which is called redemption frequency. So this would be 3 months, 6 months, something like that. So that means if you're signing up for a hedge fund, you need to be ready to stick with it for a while, because you can't really get out of the fund quickly. Now, there have been some developments in that. There's some secondary market where you can trade things at a discount. But if you want, there's no way, it's not like an open-end fund where you can go in and out as easily. So Karan showed the aggregate assets under management in alternative investments, and hedge funds were excluded, which is, I think, a big exclusion because $5 trillion, this is just one source. And this is, the big problem in the hedge fund industry is because there is no reporting requirement. It's very hard to really figure out the size of the hedge fund industry. It's like blind people touching the different parts of elephant and figuring out what that is. So this I just picked up from one website which basically gives this assets under management, and this shows it's grown over the last about 25 years to about $5 trillion when it was like a few billion dollars in the beginning of this period. I was just curious. There has been a big sort of shift that you see in the investment industry where people are shifting from active to passive management. So I thought it might be worthwhile to also put this in context of how the money has been growing on the passive side. And so you see the big money flowing into companies like Vanguard, and you see there is BlackRock and Vanguard are the two big players in this, and you can see there's a huge growth in this, and this has implications for asset prices. This has implications for profitability of hedge funds who are obviously trying to look for inefficiencies in the market to make money. So I talked a little bit about the fact that hedge funds are required to deliver absolute returns, but ultimately we want to know what is driving the returns of these hedge funds. And there's been a lot of work on factor models, and a lot of people in this room have worked on this in this area. So I'm just citing some of the work that I have done. And, so more recently I've looked at decomposing the returns of these hedge funds into how much if it is coming from what we call as the risk-adjusted performance, which is alpha, and how much of it is coming from the fact that they are exposed to traditional type of risk. Traditional risk, the most basic risk that we teach our students is the CAPM market risk. But in addition to that, you can think of size, book to market as traditional risk. But then you can also think about exotic risk, which is coming from the fact that they are actually trading in the volatility market or doing carry trades or, taking spread bets. Even if you think about momentum requires a fair amount of assessment from the manager in terms of figuring out how long you want to hold the positions, how much winners you want to buy, how many losers you want to short, and so on. So what we found in that paper was that, basically, you see that in the market, the investors are actually realizing that returns from exotic risk, non-traditional risk is important, and they are putting more money into those funds which are giving returns because of the exotic risk that they are taking. Because traditional beta returns are available cheaply. So if I want to really get a market exposure, I can simply buy a ETF which is available for a few basis points. While the exotic beta returns were much more difficult to achieve historically, but now you see there is some development in that space as well. So you have the smart beta ETFs which give you exposure to non-traditional risk, and you have this liquid alts or liquid alternatives that also provide you this exposure. So very quickly, liquid alts were basically, the idea was that mutual funds or ETFs can actually mimic what hedge funds are doing to give you the same kind of exposure in a regulated environment, because hedge funds are not as regulated as I said earlier. So you could basically, I wrote a paper which was one of the first papers on these what we called as hedge mutual funds. So when we wrote the paper first time, we called them as poor man's hedge funds. So if you didn't have $1 million to invest, you could basically get exposure to these kind of risk through investing in these hedge mutual funds. And these liquid alt managers have become much larger since we wrote this paper almost 15 years back. And you see a lot of growth there. What we found is that a lot of the managers who were doing very well were actually the managers who were coming from the hedge fund side and not the guys who were actually long only managers. in terms of one of the things that I was asked to talk about was the return driver. So, I mean, if you think about the hedge fund investors, what are they paying for? They are paying the 20% of the profits, which are total returns. They are not actually paying on the alpha. So basically, if I think of a hedge fund manager who is simply, let's say, giving a traditional beta return, why should I be paying 20% of the profits as the fees? So this is the question you have to ask. And it's challenging because if you try to contract on alpha is very difficult to contract on because nobody really has a consensus on what is the right model that we should use to estimate the alpha. And if I tell the manager, okay, we are going to use this model, it's very easy for the manager to actually game that model to generate a higher alpha. So in the literature, there have been a lot of work done, and I have a bunch of papers on different types of risk that the fund manager is taking. So you could start by thinking about liquidity risk. Liquidity risk comes from the fact that you are investing in highly illiquid securities. Then you have funding liquidity risk, which is slightly different, which is the fact that you have withdrawals from the investors, which obviously are restricted by lockup and redemption period, but still you have these withdrawals that you have to deal with, which can lead you to sell your assets at a short notice, which imposes a cost for the fund manager. Then you have credit risk, you have volatility risk, or you can even think of wall risk. And then people have documented tail risk in case of hedge funds, which is a risk which is not very easily interpretable for people who think about mutual funds, where mutual funds are basically exposed to market risk. But here we are thinking about a non-linear risk, which is the fact that there is a fairly high probability that a fund can blow up because of an extreme event, left tail event that can happen. And this I showed in a paper a long time back where we showed that a lot of the hedge funds, even though they are following different strategies, they tend to have exposures which looks like they are selling out of the money put options. So that out of the money put option selling is like selling insurance. So if you're selling flood insurance in Florida, well, you have to be prepared to pay up at some point. So I'm going to stop here and see, I think I'm running out of time. So yeah, I'm good on the time. Okay. So maybe talk a little bit more about what are the challenges for people? I know some of the people are interested in doing research on hedge funds. I mean, the big challenge is that the history is short. When I started working on hedge funds, we had about 15 years of data. Now things have become a little bit better because the survivorship bias-free data is available through commercial databases from 1994. So you have about 30 years of data, but it's monthly data. You can get some daily returns data from Bloomberg, which I've used in some of my research, but that's available for a less number of funds. So most of the research finds a positive alpha, and it tends to be period specific, but there is not much evidence of persistence, which is bad news for the investors, because if they are finding alpha, they can't find the same manager delivering alpha year after year. And then one has to be careful about all kinds of biases that people have documented in commercial databases, like survivorship bias, where you are excluding the funds that disappear, selection, the guys who report to the database versus who don't report, backfilling, where they come up with some returns when they come to the database. So academics, we are all looking for new data sets, right? So one big development that has happened in the last 10 years is that there is now a lot of use of long positions data, which is available through the 13F filing requirement, which is imposed on all asset management institutions which are putting at least $100 million in what we call as 13F assets, which is mainly exchange listed stocks and options and convertible bonds. And so there has been some work in this, including my work on trying to identify skill from looking at those managers who are trying to hide certain positions for a period of time. And a recent paper, we try to basically aggregate the information from the long positions which are reported in 13F with the commercial data to back out the skill of the manager. So we basically take the the difference between the returns you observe from commercial database versus what you observe through the 13F data when you infer it. And we show that a lot of the returns of hedge funds are driven by the things that they can do better than mutual funds. For example, short selling. So short selling contributes a large part to the profitability of these funds. Their use of confidential positions, their active trading during the quarter. These are all the things that their use of derivatives. So a lot of the mutual funds don't use short selling and derivatives. So in this paper, we actually show that some of those things actually contribute to the alpha that you observe in the reported returns, but you don't observe any alpha in the 13F. So there are a lot of guys who run these copycat funds. So if you try to copy the portfolio of Renaissance Capital, you might not be able to make money because a lot of the money that they are making is through these trading strategies that the tools that they use. Do I have time or I'm done? Okay, I can stop here and then continue, pick it up later on. Thank you.
Any quick question for Vikas, and we'll get to the next slide. Florian, you're on next. And once we are done with an overview of the markets, we'll come to the research questions that they're working on and put that together.
Good. I would like to talk about sustainable investing, which I must admit is a very fuzzy and broad field. So let's try to get an overview on what they could be and what's the state of play in sustainable investing and where markets go. So first, let's talk about market size for sustainable investments. And that brings up a first puzzle. So there's absolutely no kind of consensus on how big the market for sustainable investments are. We have different perspective. For example, on the left here, you see the numbers of the Global Sustainable Investment Alliance. It's an alliance of asset managers. It's based on self-reported data. That's basically what these people do. They go to the asset managers, send them a survey and say, tell us how many of your assets are managed sustainably in one or the other way. And then they just sum it up. And they come up with staggering figures. So the last numbers they reported for 2020 were $33 trillion in sustainable assets. That's, a sizable part, maybe 30% to 50% of all professionally managed assets. Interesting. At the same time, there's a completely different perspective from Morningstar. There's also other data providers. They really look at funds. They take a screening approach of fund prospectus, of funds names, of descriptions, and see which funds do really have an explicit mandate, contractual mandate to actually implement some sustainability related processes. And they derive, completely different numbers. So globally, the estimated market stands around $1.5 trillion. So it's more than order of magnitude in difference. I mean, what they all agree is that there is a lot of growth. I think that's a very important part of this market. We have seen a huge growth. I mean, it used to be a relatively niche beginning of 2010s. And there has been a strong acceleration, in the last couple of years, especially leading up to 20. We'll talk more about some more research development. So, I mean, there seems to be growth, but what exactly sustainable investing is, how high the numbers is a bit unclear. An interesting feature here about this industry alliance number is that the numbers for Europe, which are dark blue, are going down right now, which is definitely not what's happening on the ground. I think what we see here is that asset managers in Europe are getting more careful because of regulation, what they claim to be sustainable, which gives us an impression that, there's a lot of room for interpretation. So, I mean, key question, what is sustainable investment? It's not clear, and I think we really need to think about what are sustainable investing, how can we define them, how can we measure that. But nevertheless, let's stick for a moment with these industry-wide figures of the Global Sustainable Investing Alliance, because I think they give a nice overview on the different types of investments that are grouped under this umbrella. And it's really a huge variety of different strategies, from impact and community investing. So here we're really talking about often private instruments, private equity, private debt, venture capital in emerging markets. And so with a strong focus on on-site impact. Then we have positive and best-in-class screening and ESG integration. I think they somehow belong together. That's the idea. Usually liquid products, ETFs, mutual funds that apply certain screening criteria in their universe definition, plus maybe also some consideration of ESG risk in the later on stock selection. We have sustainability themed investment, which is a rather new thing. Kind of, so funds that focus on one specific theme, like renewables, water, biodiversity, and give investors exposure to this certain topic. Usually that's also public equity. We have norms-based screening and exclusionary screening, so strategies that just exclude certain industries or certain practices from the eligible investment universe. And that's, I would say, the most traditional part of sustainable investing. It originated with religious investors that excluded certain sin stocks, traditionally weapon, tobacco, alcohol from their portfolio. They've been doing that since a long while. Also gaining traction, also primarily public equity. And then there is shareholder engagement, which is kind of a cross-cutting thing. So strategies that use the voice investors have available, they vote in general assemblies. They may also directly interact with management to push or encourage management to move in a more sustainable direction. So if it's an alternative session, are sustainable investments really alternative investments? I think yes and no. Part of it really plays in the alternative space. Some plays more in the public equity space. It's certainly a relatively new phenomenon that I think it's interesting to think about to understand how it all works. Recently, there has been a lot of, we have a huge ESG debate. There's a huge ESG backlash in the US. And we saw this strong growth, and there has been some discussion. Have you reached peak ESG? Will these inflows continue infinitely? Of course not. But how long will they continue? And if we look at the most recent numbers by Morningstar, again, this of more strict definition of ESG funds, we actually see there is a peak somewhere in end 21, and then volumes decreased and haven't really recovered, which led some people to say, okay, now we have reached the plateau, the trend is over. But I think if we look at more detailed numbers on what's happening, so these are not global, that's all global fund assets, that's just for Europe. And markets have been in strong turbulences in 2022. And if you look at what's happening with conventional funds in gray and with sustainable funds in green, sustainable funds have proven to be relatively resilient of these market turbulences. So while we saw strong outflows from mutual fund for conventional funds, we didn't really see outflows, just lower inflows from sustainable investments. So it's unclear what will happen once markets potentially go in more calm phase and then the funds recover. So let's see. Where this is driving us. One important feature for the sustainable investment market is regulation and a strong increase in regulation. So, in my view, we're moving from a wild west world where everything goes on sustainability claims to a strictly regulated environment with different feeds across the globe. So I find this graph I found on the UMPRI website quite impressive. So they counted something almost up to 1,000 regulatory interventions globally on sustainable investing. And the interesting part here is that different jurisdictions take completely different approaches. There's like the European approach with the SFDR, who really tries to define legally what is sustainable. They have a green taxonomy who says that's a sustainable business and this not. Then they combine it with the SFDR who labels, what Article 8 fund, 9 fund. It's kind of hard to understand, very technical terms. UK has their own classification. The SEC seems to take a more principle-based approach. There has been some proposed rules on climate-related disclosure. I think that's a common feature. Currently, all these regulations, they primarily focus on better disclosures to end investors, and they try to solve this big problem of what's a green asset, what's potentially greenwashing, what's a fair green or sustainable asset. And I think also an important, interesting trend is that we see an increased level of litigation. So a bit outside of these regulatory developments, fund managers and banks are getting sued for greenwashing and increasingly successful. There have been the a case at DWS, HSBC, DK, all cases where kind of a claimant successfully said you did greenwashing, your practices don't live up to what you tell in your marketing materials, and that they were fined. And I think that's also defining what's happening on the market. So more regulation, increasing fear of litigation, leading to more, let's say, professionalization and more structured way, more complex way how the things are. I think we'll deal with research question a bit later. The other two mentioned returns, so maybe I'll say a few words on returns and leave the research for the end. That's a big question. I mean, there has been like an infinite amount of studies. Does it pay to be green? In some ways, looking at the connection between ESG performance and financial performance, there's a couple of meta studies. I just have here the numbers of the one that the New York University. They look at on corporate level. So do companies that have higher ESG performance perform better if you look at accounting values or investment levels? So if you really look at investor returns, by and large, most studies find either a positive correlation or a neutral correlation, which has kind of led to this narrative. Okay, it pays to be green. It's good to be sustainable. That's something I would like to touch in the next thing. I think there is a huge role of demand, and that's potentially something really interesting for research in financial economics to explore further.
Thank you. Right. So before we move to the research questions, I had a quick question from the panel. It seems that these three areas, the reason for the existence of the product, they're probably all different. But regulation seems to be a key reason that's driving money into climate and sustainable investing. You look at the difference between Europe and the US. Is it that's what's driving, or the investors are driving the regulators to put in laws, or are they? What's the reason that the product is there? The fact that mutual fund managers are able to get money in these themes and their fund flows. What's the reason for existence of the product? Is it primarily regulation? You have to do it. Or is this voluntary? What do you think, Florian? Yeah.
Oh, yeah, that looks good. I think for sustainable investing, I think it's investors having sustainability preferences, want to express them in an investment context, and regulation trying to catch up. So I think we had a period where, like this, what I call the Wild West, where we had strong preferences. Fund managers were basically allowed to sell everything as green they pleased, and now regulators try to push this into certain boundaries they seem more fit, or they try. There's a lot of arguments around consumer protection. A lot of the demand comes from retail investors, but also institutional investors, that they can get some pressure from their beneficiaries to do something sustainable, whatever that is.
And you think in the US, the reason the differential is because of those dynamics, the differential in those dynamics?
Yeah, the market in US is definitely smaller than in Europe. It's hard to say why. I think that the preferences are certainly more fractured in the US, with some part of the population explicitly being against ESG and not liking this idea of woke capitalism. Whereas in Europe, it seems to be way less controversial, where I think the association between investing green and sustainable and political preferences is certainly less strong.
And in the private debt markets, Yang-Soo, is regulation one of the reasons that banks cannot lend, and so the private debt market has come into play? They are like banks.
I would strongly agree with that. So, even in those white papers I said where industry practitioners, right, like they say that the biggest driver for the rise of private debt has been post-crisis regulation. So, like there has been more regulation of bank capital requirements, but also there was a leverage lending guidance, basically made banks discourage banks from being able to make riskier loans. So I think definitely private debt funds have taken advantage of that.
I see. So regulation seems to be one reason. And Vikas, what about in hedge funds? Is there a role for that? Seems to be a common theme in alternative investments. They're trying to get around some regulatory reason, or that seems to be driving some part of it. But in hedge funds, it's basically exploiting some market inefficiency or providing a new product. What would you say is the rule of regulation?
Yeah, so I agree, because the market is essentially segmented based on the regulation, right? So the example that I gave of Alfred Winslow Jones, who started the first fund, he recognized that mutual funds were not able to do certain things because of the restrictions that were placed on mutual funds by the regulation. And so that led to the birth of the hedge fund. And then, the regulator comes in and says, okay, we can allow you guys to do certain things, but then you can't really get capital from everybody, because we want to make sure that the people who are investing in this space are well informed.
So is there a lot of lobbying when regulation changes in any one of your areas? Do you know that people will go through their agencies, contact their senators in case someone says this should change or that should change, and that in turn could impact flows? Is there any research on that?
Yeah, absolutely. I'm going to talk about one such shock, which was just came out about the activists reporting, now required to report their positions within 5 business days as opposed to 10. But also in terms of the transparency that, so the regulator is coming down heavily on, and this keeps changing, right? Yeah. So sometimes the regulator will say, well, we'll need more disclosure, more transparency from you. And then the question is, if hedge funds become as transparent and, as mutual funds, then the distinction becomes blurred, because then basically you are also restricting them from doing certain things that they were able to do. So they have, so there is a body called Managed Fund Association in Washington DC, which basically is always coming out with articles to try and, push that regulation. And then they, of course, funds lobby. And so these things are obviously going on because they don't want these privileges that they have to be taken away from them, right? So,
any question from the audience on this, for this common theme, what the reason for the existence of these 3 products? Any question? No? All right. So let's go to research questions. We can start with Florian and we can go back all the way. And you're
perfect. Good. I try to. Good. Yeah. So research questions. So I had this slide before. So sustainable investing has become an active field of research in financial economics, I would say, more and more. And if we look at what's there in terms of publication, it's grouped around 3 different parts. So first is understanding the demand for sustainable investing, exactly discussion where does the demand come from, and understanding what investors want, which kind of investors want what, and so on. There's been a couple of interesting papers there, and I think like maybe Reed & Smith's 2017, I think was the first paper on these topics in Journal of Finance, kind of starting an entire new literature, or kind of being the first on sustainable investing in these journals. Then also kind of, we touched on that before, the financial impact. So is there, a correlation or kind of a causality between sustainability performance of companies, of funds and profitability? Huge field. I mean, literally thousands of studies, an older field, most of it not happening in financial economics, a lot of it happened in management as well, but also there's a huge host of studies still ongoing. And I think I would say there's a younger, strong string of literature looking at the real world impact of sustainable investing. So what are the consequences of this entire field, of this demand we're seeing for companies, for financial markets, and then also sustainability outcomes in real world? climate, carbon emissions, or also, equity inclusion and different things. I would like to focus on one aspect here, namely demand and the effects of demand, because I think that's a quite interesting field of research that is emerging right now. So if we ask any investors, so retail investors or pension beneficiaries, why they want to invest sustainably, there's roughly 3 different motivations. So one obviously is performance. So some investors assume that by applying certain ESG screens or investing in companies with better ESG or sustainability performance or climate performance, they will outperform on the long run. So often it's about risk. So that the ESG stocks are considered to be low, have a better risk profile, but also opportunities. So that's this what I mentioned before, for example, thematic renewable funds, investing in certain themes that are associated with the big transitions we're facing right now. But what's interesting is that's not the largest driver. So non-financial preferences are more important. At least this is from a sample of French and French and German retail investors. Values and impact also very important. So values, just this old idea kind of that certain investors don't want to be associated with certain stocks, these sin stocks, increasingly also fossil stocks or, other stocks. Right now also even have anti-ESG funds that do the opposite, screening out certain progressive companies. And then also impact. So an increasing number of investors actually sees sustainable investing as a way to contributing to solving real world problems, to having an impact. So, and the interesting thing is both these things, they create a non-financially motivated demand for sustainability. And if we have enough of these investors, they should have effects on financial markets. And what's interesting is that there has been some interesting studies taking this non-financial demand to explain the outperformance of sustainable investments that we saw in these larger meta studies. So the argument is if investors pile into financial products that offer sustainability, this will increase stock prices of the holdings of these products and then artificially lead to outperformance as long as we have an unexpected growth of flows into these products. There's an interesting paper by Pastor Stambach and Taylor. Basically, they show that in equilibrium, we shouldn't expect sustainable investment products to outperform, obviously, but as long as we have this unexpected, unanticipated increase in environmental concern, this could explain that. I really like the paper of Philip van der Beek, who basically says he finds a measure of flow induced performance, and he back calculates that. It's small to see, but he basically shows that he shows an outperformance of ESG products, but if he takes out the flow driven part, basically they're almost the same than the market portfolio and slightly underperforms. I think that's really interesting in the light of this big discourse. Does it pay? It seems to be outperformance seems to be flow driven. So the question is, what happens if this flow decrease? At some points they need to. But I think it's also interesting, and that's part of my research I'm doing to understand where does the demand come from. One paper we did is we were asking, obviously some investors care about the impact of their investment products, but do they care how much impact they're having? So it's an experiment where we let people do in investment decisions with various levels of impact, and we show that investors do have a substantial willingness to pay, at least it's European investors, for products that offer some level of climate impact. It's here. But we have 2 treatments. One has 10 times more climate impact than the other, and we literally see no difference in the amount of willingness to pay. So it seems that we do all kinds of tests and conclude that this demand or kind of this willingness to pay seems to be mainly emotionally driven. So investors feel good about investing green, but they won't necessarily scrutinize how much impact their choices actually are having, which could lead to a substantial amount of greenwashing. Because if demand is coupled to the feeling of greenness and not really to strict evaluation of real world outcomes to create certain incentives for asset managers. And then error bars have disappeared, but then another aspect is, I mean, if we have this huge demand and like in the beginning we saw ESG integration is the largest strategy. So I think that's certainly the most prominent thing that is happening, that some funds are having certain screens and certain processes to have a tilt towards high ESG performance. Just by the fact of that, I think that ESG ratings, which are mostly used to implement these strategies, are becoming very important for financial markets. Not necessarily because they add new information on risk, just because they steer flows. They steer assets in certain directions. And that's what we show in one paper I was glad to present yesterday. We see that if we take one of the most important ESG ratings, after this rating changes, after upgrades, ownership by ESG funds goes up, after down goes down, and this behavior is clearly mirrored by stock returns. So if you look at buy and hold returns, we see a strongly negative effect, but a relatively long-term effect, which would be consistent with this flow-driven explanations of these ESG ratings. So they become more and more important, I would say, and I think that's also an interesting field for the research. Not only, I mean, are they suited to measure risk, but what do ESG rating agencies as institutions do with financial markets, and which incentives does this offer to companies? How do they react? And also, I think in along these lines, it's really important to discuss, I mean, which ESG ratings matter. We have a lot of research in now using some of the ESG ratings. Often the choice of ESG rating is just what's right now available in the local database. A paper that got quite famous by some of my colleagues at MIT, the Agri-Confusion paper, they show that we have a huge amount of discrepancy among different ESG ratings. So it's more or less a cloud if you plot like the most important ESG ratings against each other. There is some directionality, but they conclude there is a huge amount of noise in the actual measurement of what they try to measure. They don't all agree on what they actually set out to measure, but just the underlying indicators they use, there's a lot of disagreements in things like carbon emissions, women on the board, which should be fairly easy to measure. But data quality needs to improve. But what we show in a more recent paper is that if you look at what funds, which ESG ratings, US funds at least, are using, there's a lot of agreement on what ESG performance is. So we correlated the most important ESG ratings, MSCI, Sustainalytics, Moody's, ISS, and S&P Global, on ESG ownership, so that the share of a company that is owned by ESG fund. We find that only one rating, the MSCI rating, is able to explain what these funds own and how their ownership changes. So which lends again to this argument that for especially MSCI as a market leader is becoming an important institution, and with a lot of market power of potentially shifting with their assessment asset prices, shifting assets, and potentially also the way how companies behave. There's some evidence that companies actively try to optimize their MSCI rating because they feel they can gain valuation by doing so. So I think it's a lot of interesting potential for further research, and looking forward to how the field evolves.
Thank you. Any questions?
Sure. I mean, this is like my personal interest, but try to find an overlap with your field and my field. I've heard there's been a lot of like growth in the sustainability linked loans. Do you know what's the state of the literature there? Is there a lot of research on that?
I think that's something not even mentioned. I mean, there's new, I mean, this categorization has been, that's this traditional sustainability. There's new products coming up like sustainability linked bonds and loans. I think there's quite some early papers in this direction that take new trends like sustainability loans, bonds, kind of looking at what's consequences. So I think, I feel that every trend that is coming up in sustainable investing, like net zero or diversity, equity, inclusion, is right now somebody writes a paper on it, it becomes a seminal paper on this field and then gets a lot of, so there seems to be a trend towards looking at new phenomena and new products are popping out every year, I feel.
There was one session this morning on biodiversity, which is another,
Here.
which Andrew Caroli was, thanks. All right. Let me get my phone so that. So, in terms of the research questions, I thought I'll probably talk a little bit about the stuff that I've been doing last few years on topics related to hedge funds. So I'll give you a quick sort of overview of 3 projects that I'm currently working on. And then I put together a few slides on what kind of topics I've seen other people working on, and I think there is going to be some potential to do work in that, and that actually interestingly intersects with the ESG space and private credit as well. So as you will see, as I say, I tell always the PhD students that if you're trying to look for ideas, you should think about a room and you see which is the place which is most dirty in the room is going to be the corners of the room. And so these are areas which are lying at the intersection of 2 areas. So I think that's, I believe, worthwhile for people to pursue. So the first project I wanted to talk a little bit about was this risk that hedge funds actually face when they become very large and they become very visible. So I'm sure a lot of the people in this room have heard about LTCM, which was obviously one of the largest fund at that time, and which lost money despite having all the money flowing into that fund. And one of the things that happened for LTCM was that they were very large and their positions were kind of known to other people in the market. And there is this idea of front running, which can hurt a trader. And this notion has been sort of theorized in papers by Brunemeyer and Peterson as predatory trading. And so we wanted to, in this paper, which is joint work with George Aragon, Vikram Nanda, and Kelsey Way, we basically try to understand if you are a large hedge fund, which we call as a mega hedge fund, which is $1 billion or more in assets. And if you get into trouble, then how do other informed traders in the market respond to your distress? And so you can imagine that if they know that these mega hedge funds have to sell their assets in order to deal with the outflows, what other fund managers might do is to sell before them, because if they were going to sell these mega hedge funds, then it will have a negative impact on other traders who are holding similar positions. So that's one way in which they can minimize the losses to them. The other thing that they could do is, if they don't hold the positions, they can actually try and short those stocks that they believe are likely to be sold by these distressed mega hedge funds. And so we find evidence which is supportive of both these things, that on the long side, typically other hedge funds and mutual funds will start selling the same stocks that these distressed mega hedge funds hold prior to the selling by the distressed guys. And this effect is particularly strong if you look at illiquid stocks, where the impact is likely to be much higher. It is also more pronounced when stocks have more ownership by what I call here as vulnerable funds. These are vulnerable mega hedge funds. And the institutions that tend to front run are the institutions that themselves have more discretion and incentives to front run. So it's not the insurance companies and pension funds which are doing it. It is mainly other hedge funds and mutual funds which engage in this. And then we show that this actually negatively affects the performance of the distressed mega hedge funds, because now other people are selling before you. So your stock prices are going down, so your portfolio value goes down. And what happens as a result of that is that when, so these stocks that are held by the distressed mega hedge funds then experience a decline in their returns because there is this massive selling that is going on. But there is nothing fundamentally wrong about these stocks. So what happens eventually is that these stocks then bounce back. So this has implications for financial stability because it introduces this sort of volatility in the stocks, underlying stocks. So the bottom line of this research is to basically show that even if you are a hedge fund, you are not immune to front running by other guys, right? So if a big shark gets into trouble in the ocean, there are a lot of small fish which will go after the meat. So you will see that even in this hedge fund space. The other project, which is with Bin Wang, who is here, and Gary Chen and Zhen Shi, this is actually sort of, this paper is related to some work that I did initially on trying to understand the incentives of hedge fund managers. As I mentioned earlier, that hedge funds get compensated very lucratively through 20% of the profits as your fees. Now the question is that we know that as Benjamin Franklin said, death and taxes you can't avoid. So taxes are very important, right? So taxes should affect the incentives of the fund managers. And so our paper is the first one to actually look at the personal income tax rates of hedge fund managers and try to understand how does the tax changes then affect the incentives of these fund managers to work for the fund. So if you increase the taxes a lot, then the manager will say, I might as well go and have a nice time in Hawaii rather than working for the fund. An alternative story is that maybe if I increase the taxes a lot, the manager would say, well, now there is a loss of income. I need to work harder to make up for that loss in the income. So we try to basically look at these alternative explanations, and we find that hedge funds actually perform worse once you increase their taxes, income taxes, and which is consistent with this notion that they are actually working less for the fund. And to then basically drill down this a little bit more, we look at the 13F holdings that I talked about earlier and show that these managers actually try to go for stocks which have lower information asymmetry. So you don't want to work very hard. So if you're drilling for oil, you don't want to go for drilling too deep because you don't have that strong incentives to work. And then we also try to take advantage of some of the differences in the cultural preferences of people towards leisure. So Florian talked about Europe. Europe is very different from US, not only in terms of sustainable investing, but also people like to have a good time. Like in Europe, people want to have a much better balance between work and personal life. And so we find that if you actually value leisure more, then you are more affected by this. So this actually is again consistent with this idea that taxes affect the incentives. So how do we actually deal with this loss in the incentives? Well, you can, if the manager has more co-investment in the fund and if they have more career concerns, then actually it blunts the disincentives of the taxes. That's something we show in the paper. And the last project that I've been working on, we sort of try to look at something interesting, which is how funds are named. And, people name the funds after themselves. And this phenomenon is called eponymy. And we wanted to understand, why does Karan name his fund as Karan Capital versus Alpha Fund, which a lot of funds have in their name. So this actually gives us a window into trying to understand if the managers are using the fund names in a way to signal something about their ability or their trustworthiness. And what we find in this study is that when they name the fund after themselves, they tend to actually do this to signal that they are more trustworthy and they are more ethical. And we show that they actually indeed are less likely to engage in regulatory violations. They're less likely to do any kind of returns management and stuff like that. And just like in any theoretical model on signaling, there has to be cost and benefit. So we show that these funds receive lower flows if they actually violate after signaling that they are ethical. So there is like a breach of trust. So this is the cost for a manager to name the fund after themselves if they don't actually act ethically after that. And the benefit is that they will receive higher flows if they don't violate. So the investors are, happy to see that they keep the word that they are signaling through their name. So these are some of the themes that I have been working on, but there are a lot of new themes that people are working on, and I thought I'll quickly share that. I think I've run out of time probably. So maybe I can just leave it for questions later on, maybe, and then show it. Yeah.
So let's quickly move on to the research questions in private debt, and then we'll wrap up.
So I'll quickly talk about why there has been so much increase in private credit, and then some thoughts on future research. So there could be many explanations for the rise of private credit. Here I just picked out 4 that might be really relevant. So first, bank consolidation and increased banking regulation. So we talked about it a little. So, in the figure on the left, shows you the fraction of securities, mortgage loans and non-mortgage bank loans as a fraction of GDP. And you can see that, in the past 20 to 30 years, bank corporate lending has not kept up pace with other activities. The figure on the right shows you, for the U.S. commercial banks, the fraction of all bank corporate lending to the fraction of total bank assets. And you can see here, in the past 20 years, consistent with the left figure, that's been on decline. And many people refer to bank consolidation in the early years, 1990s and in the early 2000s, and bank regulatory tightening. So Dodd-Frank and Basel III were capital regulation on banks. Leverage lending guidelines I talked about a little earlier, so on bank lending standards. So I decided to not put papers here because there are so many papers that document that tightening of bank regulation post-crisis were responsible for the rise of non-banks. I can name a few. For example, Irani et al. 2021 RFS paper shows that capital regulation were responsible for the rise of CLOs. In the case of private credit, and also all other non-banks in the middle market sector, Chernenko et al. RFS paper also documented as well. Another potential supply side friction kind of reason for the rise of non-banks could be and these are all not mutually exclusive, so this can be related to regulation. That banks may be just reluctant to certain types of firms. So in our survey that I mentioned before, we asked these direct lenders that we surveyed why they think the firms come to you. Like why they think those firms cannot get bank financing. And we gave them a lot of options, and let me just summarize. Banks seem to avoid lending to smaller firms that are too small for bank syndication, and firms that have lack of tangible assets and low transparency. So this could also be related to regulation or not. Now, maybe some more demand side explanation. So, as I mentioned earlier, you cannot really separate private debt from private equity because they're so interconnected. So, private equity buyers are the main market place for private debt. As we estimate in our survey, 78% of U.S. private debt funds loans are for private equity buyers. It's a bit less in Europe, so it's around 42%. In the U.S., so BDCs only is in the U.S. In the case of BDCs, in my paper, I find that it was around 51% in 2012, but has grown up to like 63% recently. So one speculation is that maybe the rise of private debt just mirrors the rise of private equity, and that private equity sponsors like to work more with non-banks than banks. Kind of related to this, in my paper, I find that prior relationship between a direct lender and a PE sponsor predicts more future credit supply, especially in times of distress. Lastly, it could also be the case that direct lenders are has more advantage in providing customized needs that borrowers need, as opposed to getting from bank loans. We also gave them in our survey. We also gave them a lot of options, asking them why do they think the firms choose, nonetheless, them having access to bank loans. And 4 major themes is that first 2, certainty and speed of execution, and stable relationship with lenders' expectations to maturity. So both of them relate to kind of direct lenders' commitment to the firms. Also, they say that direct lenders are more able to provide more flexible covenant structure, and they may be more willing to provide more leverage than banks are willing to support. This is some of my own work as well. So I kind of extend this idea where in my paper I accessed proprietary database for direct lending deals and bank lending deals that were just in distress. And both had similar nature of distress during the COVID period with similar contraction in revenue and also similar reasons for distress. However, I see drastic differences in the way they resolve distress. And there are two notable patterns. First, direct lenders exhibit greater flexibility in renegotiating on the court. They're more likely to defer payments through renegotiation. They're less likely to put firms into restructuring, which means change of ownership, and less likely to put them in bankruptcy. Second, this kind of relates to the previous idea about relationship with PE sponsors. Direct lenders are more likely to induce the PE sponsor to put in additional equity during distress renegotiation. And also, PE sponsors were less likely to exit the firm post-distress. So both of these kind of suggest that maybe direct lenders have better relationship with sponsors than banks do. So those are my thoughts over why the private debt has increased. Now, I have a few observations I think could speak to or create some room for future research. So first of all, as I mentioned a while back before, so high returns, low volatility in this market outperforms over leveraged loans and high yield bonds. How should we reconcile that? Like, are returns smooth or returns actually smooth in nature? So I think this could be a fascinating area for research. And someone brought up about valuation. So I'll be very much curious to see how valuations are done and how often they use third-party services. Second is more of a kind of fundamental theoretical question that I've been wondering about. So, at least based on my research and also our survey, direct lenders do exactly the same things as banks do. Like they provide monitoring intensive loans, they provide relationship-based loans, but with a completely different financing structure on the liability side. They use locked up capital. So like basically monitor that finance with locked up capital. But as I mentioned before, direct lenders do, like BDCs and private debt funds, do use some leverage from banks. So 3 questions from this. First, how should we reconcile with banking theories that posits that banks are special in the sense that they need the fragility in the deposit structure to incentivize them to do monitoring? So if these guys can do the exact same thing with a completely different financing structure, what does that mean for those theories? Second, to the extent that that the direct lenders borrow from banks, on the flip side, why are banks lending to the direct lenders when in fact they could have lent to the firms that direct lenders are lending to? Is it a regulatory arbitrage, or is it just equilibrium outcome where they think that it's better that direct lenders serve them, and then it's just smoothing competition? Finally, another interesting thought is that to the extent that private debt funds have very similar financing structure as private equity, and also similar funding sources, prior literature on private equity have shown that private equity tends to be procyclical. So what flows into direct lenders be procyclical, I think that would also be interesting to know, more of a macro-related question. Finally, in recent news, there's been a lot of news saying that direct lending deals are getting very big. Like, for example, Finastra raised $5.3 billion direct lending deal a couple months before. Like, and this was unprecedented because like direct lending deals never get over $1 billion, at least a couple of years ago. So does that mean that direct lending is taking over the public markets, and what terms of the public markets converge with private markets? So I think all of these are interesting and fascinating research questions. At least I'm interested in. So hopefully some of you can also look into this as well. Thank you.
Thank you. I think wonderful. So we have 5 minutes for any questions from the panelists, I think, or any discussion that you might want to have. Are there any questions, or from each other at all? It was pretty. I think the alternative investments field or the existence of these products, the reason for their existence is not clear, and hopefully this shed a little bit light on that. At least I was not clear on what is this private debt. And my MBA students would ask me, some PhD students ask me, there is no database. In hedge funds, they continue to grow. And in sustainable investing, like I think Vikas was saying, there's so much murkiness and we are not clear what it is. Hopefully this sheds some light for all of you. Yes, please.
have a question regarding your income test paper on hedge fund managers' performance. I'm wondering now whether you look at the flow of it. I mean, my question would be that do hedge fund investors understand what happened if you when personal income tax increased and hedge fund manager they reduce their work incentive, and then that lead to a worse fund performance and to their investor. Are their investors aware of that?
That's a good question. So let me use this microphone. Yeah, so I think just to repeat her question, so I think the question was related to how do the hedge fund investors respond to the fact that the manager is now facing higher taxes, right? So that's the question. And so we did look at the flows and we report that in the paper. We did not find a flow response by the investors. On one hand, you might think that if the investors can understand that this is going to negatively affect the manager's incentives to work for the fund, then they might withdraw. But at the same time, you also can think that when you increase the taxes, some of the individuals who are investing in hedge funds are themselves also affected by the taxes because they are also high net worth individuals. So there are multiple effects that are going on when you change the tax rates, right? Because the investors are also directly affected by the tax changes. So we discussed that in the paper, and we did look at the flows.
All right. Any more questions? Otherwise, yeah, go ahead. Yeah, anyone? Okay. Well, thank you. Thank you to our panelists and for taking the time.
Thanks, Karan.